Welcome to BTFDtv. My name is Jack Barnes, and it's August, and we're starting the next season of shows, and Attain Capital has returned. Jeff, it's been a while since we've chatted. How's your summer been treating you?
Hey, Jack. It's good. It's been busy. Been bouncing around with the kids, but we're ready for some market action here, heading into the spring or into the fall.
All right. I think you have a disclosure you have to read by law, one of those horrible things.
I do. Let me get that out of the way for you guys here real quick. Past performance is not necessarily indicative of future results. There are no guarantee that any investment product will achieve its objectives, generate profits, or avoid losses. The risk of loss in trading commodity futures contracts, whether it's one's own or through a managed account or pooled fund, can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, as futures trading is not suitable for all investors. Any investment in the products mentioned herein requires investor qualification as an accredited investor and the receipt of an offering document. There you go.
All right, we got that out of the way.
Yep.
Now we can go. Now we can actually start the dang show. So, what has Attain been up to this summer? I know that you guys have been focused on rolling out some new strategies. Can you give me a little detail?
Sure. Yeah, it's great to be back on, and really appreciate you taking the time here. It's been a busy summer, and it's been a busy actually couple of years. We've been working with our managers, a part of the business that you might not know. Just a little bit of background, I guess, might be helpful to the viewers. We've been involved in the managed futures industry, really seeking out and targeting top trading talent around the world for about 12 years. And over that time period, there's been a lot of evolution in this space, which I'll talk about here coming up. But more specifically, and what we're here to talk about today, is the rollout of our family of funds. It's a 5-manager platform, more or less, of direct investments into pooled vehicles that offer investors lower minimum access to top-tier strategies that might typically command in the range of $1, $3, $5 million to start. Can get people get involved at lower minimums through our vehicles.
Very good. So I believe we have one of your managers with us.
We do. We're really lucky to have Roland Ostrip from IMFC. They're a fund manager and portfolio manager we've been working with going back to almost 2007, I believe. When we first had the opportunity to meet Roland and his team, we saw some really unique things, including a binary watch that Roland wore into the first meeting. But all of that's to say that he's been a great partner for us over the years, and as we've moved forward here to the launch of our product, our platform, we have greatly appreciated the opportunity for him and his team to select us to be a part of their rollout, which includes now a U.S. onshore fund that had previously only been available in Canada. So.
Okay. All right. Roland, welcome.
Thanks, Jack.
How about giving us a little bio about yourself, and then we'll ask some questions. Dig into your formulas, your strategies, how you generate alpha in the market.
Sure, no problem. Thanks, Jack. Well, I am CEO and Chief Investment Officer of IMFC here in Canada, as Jeff mentioned. In addition to that, I sit on the advisory board of the Master of Quantitative Finance program at the University of Waterloo, and one of our principals co-founded that department, and also sit on one of the advisory committees for our regulator up here at the Ontario Securities Commission. That's me in a nutshell. I started in the industry in 1988 as a currency trader, spent a number of years in the investment industry, decided to start my own business. I've assembled a great team here, and we run basically a macro hedge fund portfolio that looks to trade in long-term directional markets or moves.
Very interesting. I'm going to enjoy this show. So where is your focus right now in the market?
At a broad level, I'll just categorize it very simply. We still remain long the equity markets, though the portfolio is hedged entirely right now. In the interest rate market, we have mixed positions. We see that more as a trading range market right now. So we have some long positions in the longer dated instruments, particularly in the U.S., but we have some short positions where the rates are exceptionally low, like in the 5-year area and in specific markets. So for example, the German 5-year and the Japanese 5 years. We have a mixed bag of positions in the commodity markets because they are responding to their own fundamentals right now. So we can talk about everything from the crude oil market to the grain markets, where we're mostly short in that area. We have mixed positions in the metals markets and the energy markets. And again, in currency, I would say we're biased right now to short the currencies where the central bank policies are a little bit more accommodative.
All right. All right. So did I hear correctly that you're short the 5-year bond? Is that correct?
Yes, the bobble, the 5-year bobble.
Sorry. I've been out of the game too long. I'm starting to confuse my terms. I apologize. Where do you find the most alpha at this time if you're looking at your crystal ball, looking at things in the big sense? Because there's a lot of geopolitical risk in the market, as you and I both know from our own perspectives. Where do you think the alpha is right now?
Well, I think if we look at our portfolio, we've been saying this for well over a year now, that we would expect that the greatest opportunity for us is going to come from the commodity and the currency markets. And to understand that, you really have to look at what we've gone through since 2008. When you go through a financial crisis, currencies tend to offer very few opportunities as you see global coordinated central bank intervention. You know, as you get past the crisis and it starts to dissipate, monetary policy or central bank policy starts to become domestically driven and therefore divergent. And so really what we're seeing in the markets today, and it even started last year where we saw it with the yen and Abenomics, is you're seeing divergent central bank policy that's causing currency trends. So this year one of the big winners has been long the pound against a short euro position. Similarly in commodities, we've finally gotten out of that risk on, risk off. And you're starting to see commodities move on the basis of their own fundamentals. When you combine that with the fact that valuations are extremely stretched in traditional assets, it's hard to argue unless you see a crisis and opportunities on the short side that there's going to be significant sources of alpha or return opportunities from the long side of traditional assets.
All right. Let's take a look at crude. Both at a dated Brent versus WTI. Do you guys have a preference at this time?
I wouldn't say we have a preference at this time, though we're slightly more short Brent at the moment than WTI. But the positions are so insignificant. The problem with crude is that you're really in a market that's still stuck in a trading range, mainly because the geopolitical risks haven't caused any disruption to supply, and at the same time you don't have any catalyst for demand.
I agree with that, actually. So that was kind of short and sweet. Let's take a look at interest rates. What are your thoughts on the U.S. trend over the next year?
Well, over the next year, I think what you're going to see is, as you're seeing today in the markets, anytime there's any suggestion that the Fed might be ahead of schedule in terms of becoming less dovish, you're going to see a normalization in interest rates. We don't see any major trends emerging in interest rates. Rather, we see it as a trading range market, and certainly we've just had geopolitical risk cause the bond markets to rise, and as that abates and you see some comments from the Fed, as we did today, that's going to put pressure. So we're really in a trading range market in interest rates, and that's how we're treating it. Basically, we tend to try to go short as the rates get lower. We were able to do that in a couple of markets, and then as rates back up again, we unload those and are still biased to the long side, because until you get a real meaningful acceleration in the economy or inflation, and particularly wage inflation, you wouldn't expect to see any meaningful movement in the bond market other than just a normalization of rates. All
right. Jeff, do you have anything you want to add, dive in, share?
Sure. I think it's interesting from where I sit. I have the opportunity to track a large number of managers that are trading in many different styles and on many different time frames. And we're seeing a lot of the same of what Roland is talking about, that in particular interest rates, it's the range-bound scenario where there's opportunities both alongside and into the short side over depending on the time horizon that you're looking at. And also on the currencies, it's been quite interesting. It's been a market that people that know me and that I talk to the client side, I've been calling for a long dollar trade to emerge here for a long time. But I've been wrong. I don't know, up until maybe now. I don't know if this will be it, but the way that the euro is trending, there's more and more strategies and managers jumping on board to the short side, which may potentially end up driving prices even lower. But as we all know, when it comes to currency, central bank intervention ultimately rules the roost. So despite what we all might think and involved in on the trend side or trading side, they have a much bigger balance sheet than us. So.
Never fight a printing press, I think, is the old line.
But I will say, though, that I feel that if Europe does tighten even further, that would be opportunistic for that trade. And in particular, it seems to me that over the last many years, it's been a scenario where U.S. does something first and then Europe, and I think that's just how the world works these days. And so, good chance they might do it. We'll see.
All right, Roland, thoughts, comments? We're at the stage where you can give us a spiel. You can share, or you can bring up any topic you would like to discuss.
Well, I'm going to start with, I'm just going to follow on Jeff's comments on the currencies, and then I'll jump to some other markets. I have for years, probably since 2011, thought that the U.S. dollar on the long side is a good retirement trade. That's not shared universally with my colleagues, mind you. I was surprised to see it rally, but this is the thing about markets. When you look backwards, you perfectly understand why something made its moves. And really, one of the things that drove the euro up earlier in the last couple of years was nothing more than the fact that as the crisis abated, the yields on the peripheral bonds was quite high, and certainly the equity markets in Europe had lagged as well. And so you had these huge investment flows going into Europe in search of higher yield and cheaper valuations in equities. And typically when investors do that, they do so in an unhedged manner. So on a speculative flow basis, you saw tremendous flows going into Europe, and that was really what was underpinning Europe, despite the fact that the fundamentals are certainly a lot weaker for the euro. And so maybe that's changing today. Again, it's we're seeing some evidence of that now. That really it's as we see a divergence in monetary policy, that's starting to favor the U.S. dollar. So again, as Jeff said, maybe this is the launching pad. Who knows? But it's certainly a position that I think is a worthwhile position. And if you look at it from a valuation standpoint, certainly the U.S. dollar is quite low. Historically, and also relative to its purchasing power parity, even how it normally trades in relation to its purchasing power parity. Yeah. And the other area for opportunities that we continue to see are in the commodities. Certainly in the industrial metals and in the agricultural commodities, we see tremendous opportunity. Some of the commodities, some of the crops are cheap. Other ones are such as corn, are still fairly elevated from cost of production. And one of the opportunities that you get in commodities is even when they're cheap, if you're in an ample supply situation, you get a situation where the futures prices trade significantly above the cash prices, and so you're actually paid a yield for shorting those contracts over and over again.
All right. Thoughts on corn right now? It's first was supposed to have been a phenomenal season. A lot of acreage was put in. And what we're seeing on some of the crop tours in real time right now is that there's been a lack of rain, and the yields are not quite as high as they thought. But because so many acres are planted, they could still have an all-time record. And so I guess what I'm asking is, do you see corn bottoming in the near term?
Well, in the near term, Jack, that's a tough call. I mean, you may as well flip a coin on that one. I mean, a lot of people say the market is oversold. Well, in a bear market, it always looks oversold. That's the reality. If you do get a true shift in the fundamentals, the market will always look oversold. So, can you get technical reactions and technical bounces? Yes, I would say that really the market has sort of corrected a little bit over the last few weeks and is now breaking down again, and that is on the backs of, again, bumper crops. I think the bigger issue is actually not so much that that there's been I think the one thing that could be supportive of corn is the fact that one of the things that's being underestimated is the degree of abandonment in some of the areas where you've had hail. Certainly the yields, I don't think that they're still coming in, fairly high, and certainly at record levels. So that's not going to help corn in any way, shape, or form. The one thing that might is that there might be a higher rate of crop abandonment because there were specific areas that were impacted by hail.
And I've even heard some farmers saying that they're not going to harvest some of their fields this year. They'll let them sit through the winter because they're not going to pay to dry the corn. And it's better to let it sit out there for the winter at this point.
Well, maybe, but the reality is, if you look at the cash cost of production on corn, it's pretty low. It's $220. So, and if you put labor in there and whatnot, it comes in at $324. So that would be a surprise to me if they didn't harvest the corn. Actually,
this was up in Minnesota area. It was an area of damaged corn up there where they were like,
sure. If you're going to have the damage there, yeah, absolutely. Then you could see that happen as well, Jack, for sure.
So let's also take a look at, you said, industrial metals. Which ones do you like? Which ones don't you like at this time?
Well, we don't have a lot of positions today. It's rather that we see an opportunity in the industrial metals, and I'll just pick one as an example, but we can expand it to others. Again, one of the other trades that I've often thought of as the retirement trade is the ability to go short copper. Again, not agreed on universally with my colleagues here, but you have to respect the market. And if you look at copper, which is down about 8% this year, there is the potential to go down a lot more. But if you look at Chinese buying this year, it's been about $3.5 billion worth of copper. What you're seeing is that any time copper goes down, you're seeing Chinese buying in the marketplace. And one of the reasons they're doing that is because a lot of the loans in China are collateralized by copper. So
yes,
to keep the loans afloat, you've got to artificially support the prices. But the reality is, and this is sort of across all commodities, but I'll bring it home to copper, is that generally speaking, commodities go up for one of two reasons. Typically, it's due to a supply shock, but every once in a while you get this tectonic demand pull, such as what we've seen in the last decade and a half with China and the whole emerging market growth story. And then there's a delayed response to get supply to market. Well, supply has certainly caught up, and we're no longer in a situation of being concerned about deficit production in many of the metals. And what tends to happen when you remove the catalyst that drove prices up is prices tend to drift back towards cost of production. In the case of copper, it's quite a bit lower than where we are now. We're certainly about 30% above where copper could go if there are no supply problems in the marketplace or major new sources of demand. So there's a market where we can see that it's being supported by an exogenous factor. But if anything meaningful happens to cause China to not support the marketplace, there's a lot of room for copper to fall right now. On the flip side, though, Jack, very quickly, the same was the case in aluminum, but what you've seen is you've actually seen a producer reaction where you've seen supply cuts now from the likes of Alcoa at the same time as Ford's demand is quite high. And so you've gone from surplus to deficit, and so that market looks a little bit more constructive. Again, the markets are moving on their own specific fundamentals as opposed to broad sector or macro fundamentals.
Would you say this is the first time the markets have done that in a while? I've been out of the business for this period of time, and so I can't speak for the last couple of years. What are your thoughts? Is this a scenario where we're finally freeing ourselves from the past crisis?
Yeah, I would say that we are in the same fashion that people talk about normalization of interest rates once QE ends. I would say that as this crisis has, as we've had more distance between the crisis and where we are now, and it has been several years now, we're seeing a normalization in how markets are behaving on their own fundamentals versus sort of broad macro fundamentals, and that's showing up in the performance numbers. We've gone through years where the more directional strategies of macro and managed futures have sort of kind of been mushy. They've kind of underperformed. They've been flattish in an environment of declining volatility and high correlation. Well, those correlations have broken down and volatility is very low, and that's a very constructive backdrop for the industry.
All right. I was wondering what your thoughts are on China, because they are kind of the engine of growth, and if they are in fact slowing down at a real level, thoughts of their forward growth rate, which obviously won't be double digits if in fact they are arriving at a new level of forward motion.
Yeah, well, again, I probably can't give you any great insight that you couldn't get elsewhere. I think I'll go with the consensus that their growth rate is certainly moderated down into the 7% range if we're looking longer term in terms of what we expect. That's still extremely robust, and it's very supportive of the structural underpinnings for the broader economy long term. In the sense that at the end of the day, global GDP growth is what is going to drive long-term growth in earnings and labor markets. But having said that, a moderating growth rate at a time when you've seen supply responses in commodities is not necessarily going to be bullish for commodities. It may, so if you have accelerated growth, it might benefit it. But certainly, if you just get consensus growth, I think you're going to be in a situation similar to some degrees as we were in the 1980s, where you had a reasonably positive equity market, but commodities continued to go down. The economy was growing, but commodity prices weren't keeping pace. The difference, of course, today is valuations are certainly much different in equities than they were in the early 1980s.
Yes. Yeah. Yes. Jeff, anything to add at this moment?
Yeah, I think there's a discussion. Roland started to touch on it here just briefly, is that commodity prices potentially going down like they did in the 80s. The scenario that a lot of people on their brains is what happens in an inflationary, if inflation starts to hit. Where will commodities go, and ultimately how are you able to capitalize on that opportunity? I think that many of the strategies that we're involved in particularly Roland's strategy, the macro view, the ability to participate in commodity movements that are tectonic, I think that phrase was used earlier, is something that people need to be conscious of, and also know where they can go and potentially find return opportunities. And so maybe if Roland could just speak a second on how you view inflation and the ability to where we can capture returns there related to commodities.
Yeah, sure, and that's a good point, Jeff, because I've overemphasized the opportunity in the short side, which I'll just recap quickly by saying that anytime you have a dislocation between long-term cost of production and price, you have potential pockets of air unless you have sources of demand. That does not mean commodity prices can't go a lot higher, as they did in the 1970s, as an example. Certainly, if we saw inflation unlock, and you would probably see significantly higher commodity prices unless the Fed was able to rein in money supply and velocity quite quickly. I think, though, you're not likely to see inflation in the short term. What you would have to see to get true inflation is wage inflation, and that would mean tightness in the labor market and full employment. Otherwise, all you get is an increase in commodity prices that chokes out an economy.
Yeah. I saw a stat, and gonna forgive me for not getting it exactly right, but in China, speaking of China, the wage growth there has been somewhat moving towards exponential, and so as an emerging economy, and that may end up putting pressure on commodities there as well.
Certainly it could. I think even here you have the potential to see an exponential. It's kind of like an elastic band. If you hold back, if companies hold back capital investment and expenditures long enough, ultimately when that unlocks, if the money supply is there, you might get a very quick response in the labor market, which could be very inflationary. Obviously, that would be very good for directional strategies.
Do we have any expectations of inflation at this time?
That depends where you look, I suppose. In Europe, no, we're still sitting at 0.4%. You know? I would say I don't see any meaningful appreciation in inflation unless you see the economy continue to recover, you see bank lending increase, you see employment increase. In that case, you could see, again, a very violent and quick uptick in inflation, not just a subtle one.
All right, we're down to our last 5 minutes, and before we wind up this episode, I first want to thank you very much for joining us. Roland, I hope you will return at least once a month, and maybe we'll do a series of these conversations and see where your opinion is on a month-over-month basis, if you're interested. But before we do that, I have to ask about the chart over your shoulder. The duck versus, is that a rabbit?
It's a duck on one axis and it's a rabbit on the other axis. It's just all about the world can look different depending upon your perspective. You can be bullish or you can be bearish. You could see a duck, you could see a rabbit. Unfortunately, we couldn't find a way to do that with a bull and a bear.
So any last comments before we wind up this episode of BTFDtv with Attain Capital?
From my end, I would just say think long-term, think fundamentally, and cut your losses and let your profits run.
Jeff?
That's pretty well said, and I think from where we are, it's educate yourself on what the opportunities are in the commodity markets. Don't forget about them in the current equity market bull run, because ultimately, once equities do pause or even retreat, you need to know where and how to successfully allocate to lowly correlated asset classes. And as we've seen, and as I've been involved in this industry for over 15 years, there are opportunities that arise in commodities on a regular basis. And it's not just the opportunity that might be there, it's putting risk management around it and knowing how to be successful once in a trade. It's, anyone can give you a tip that you should go long crude or other things along those lines. It's important that you have sound fundamental risk management around your trading, and that's why we hired Roland, and that's why our clients hire Roland, and why we recommend investing with him.
Very good. I want to thank both of you for joining us here at BTFDtv. This has been the Wednesday After the Bell episode. We'll be back next week, and I look forward to you guys joining us again. Before we go, Roland, I have a macro tourist show on Sundays at 7 p.m. Eastern, and I'd love to have you drop in and join us. Next week, in 4 days, is already booked, but the week after is open if you would be interested in joining us. I'd love to have you drop in for an hour. There's no script, and you just bring whichever topic you want to discuss.
Well, it'll be my pleasure, Jack. I look forward to it.
Very good. I'll be in touch off air. On behalf of BTFDtv, this has been the Wednesday show. Thank you.
All right, Jack. Thanks so much.